Hello everyone. In this particular unit, we are going to discuss about accounting standards. Students, let's discuss what is the meaning of accounting standard. Accounting is the language of business. It may also be stated that accounting is the language of all other organizations. All financial information like nature of financial activities, financial position, financial result, etc. are available through accounting. Accounting has been in existence ever since the dawn of civilization, where a person in the settlement wanted to keep track of his belongings and ensure a legal claim on his holding, be it land or livestock. However, Luca Pacioli has been regarded as the father of modern accountancy for his noteworthy works describing the system of bookkeeping, that is, the double entry accounting system, which is widely accepted across the business world even today. As time progressed, a natural evolution of accounting became evident. Industrial revolution and voluminous transactions in a complex financial and business environment led to need-based accounting specific to the nature of transactions involved. The urgent demand for uniform accounting standards was felt in early 1930s, post the Wall Street crash of 1929, following Great Depression. The American Institute of Accountants, which is now known as the American Institute of Certified Public Accountants, and the New York Stock Exchange attempted to launch the first accounting standards in the 1930s. The evolution of the international accounting standards began in 1966 with a suggestion to set up a worldwide study group. The next year, the Accountants International Study Group was formed and it began to publish papers on various accounting topics, some of which form the foundation for accounting standards that came into force later. In 1973, the International Accounting Standards Committee, IASC, now International Accounting Standard Board, IASB, was set up with the objective of developing accounting standards that would be internationally followed. In 1973, the International Accounting Standards Committee, IASC, was set up with the objective of developing accounting standard that would be internationally followed. In 2001, the International Accounting Standard Board, IASB, formed under the International Financial Reporting Standard, IFRS Foundation, replaced the IASC. Now let's talk about Indian Accounting Standard. For this purpose, the Institute of Chartered Accountants of India, ICAI, which is also a member of International Accounting Standard Committee, had constituted Accounting Standard Board in the year 1977. Accounting Standard Board identified the areas in which uniformity in accounting was required. After detailed research and discussions, it prepared and submitted a draft to ICAI. After that proper examination, ICAI finalized them and notified for its use in financial statement. The so-called financial informations are communicated to the users, both internal as well as external, of accounting information by preparing and presenting the financial statement. As such, it becomes necessary to develop some generally accepted accounting principles, popularly known as GAAP. While preparing the financial statements by which the language of the business can be communicated to the users. Thus, the principles which are formulated or developed in this regard and which are approved by the specialized bodies are known as accounting standards. Practically, it will help us to assess the progress or otherwise of a firm after comparing the actual performances with the standard. Now, let's talk about this meaning of accounting standards. So, accounting standards are written statements consisting rules and guidelines issued by the accounting institutions for preparation of uniform and consistent financial statements and also for other disclosures affecting the different uses of accounting information. According to some authorities like Yorston, Smith and Brown, a standard is a performance, target, or goal, or an agreed criterion of what is proper practice in a particular situation. There are some other authorities who prefer to use the term accounting principles in place of accounting standard. In short, accounting standard may be defined as the accounting principles and rules which are to be followed by various accounting treatments while preparing financial statements on uniform basis and which will reveal the same meaning to all the interested groups who will use the same. Thus, the standards are considered as guide for maintaining and preparing accounts. Now let's discuss about objectives of accounting standards. In earlier days, accounting was just used for recording business transactions of financial nature. Its main emphasis now lies on providing accounting information in the process of decision making. For different purposes, accounting standards are needed. The first one is for bringing uniformity in accounting methods. Accounting standards are required to bring uniformity in accounting methods by proposing standard treatments to the accounting issues. The second is for improving the reliability of financial statement. Student, as you know, accounting is a language of business. There are many users of the information provided by accountants who take various decisions relating to their field just on the basis of information contained in financial statements. In this connection, it is necessary that the financial statement should show true and fair view of the business concern. Accounting standards, when used, given a sense of faith and reliability to various users. They also help the potential users of the information contained in the financial statements by disclosure norms which make it easy even for a layman to interpret the data. Accounting standards provide a concrete theory base to the process of accounting. They provide uniformity in accounting, which makes the financial statements of different business units for different years comparable and again facilitate decision making. The third objective is simplify the accounting information. Accounting standards prevent the users from reaching any misleading conclusions and make the financial data simpler for everyone. The fourth one is prevents frauds and manipulations. Accounting standards prevent manipulation of data by the management and others. By codifying the accounting methods, frauds and manipulation can be minimized. The last or fifth one is it helps auditors. Accounting standards lay down the terms and conditions for accounting policies and practices by way of codes, guidelines, and adjustments for making and interpreting the items appearing in financial statement. Thus, these terms, policies, and guidelines become the basis for auditing the books of accounts. Now, let's discuss about benefits of accounting standards. Accounting standards are the ruling authority in the world of accounting. It makes sure that the information provided to potential investors is not misleading in any way. Now, let's discuss the first one. Attains uniformity in accounting. Accounting standards provide rules for standard treatment and recording of transactions. They even have a standard format for financial statement. These are steps in achieving uniformity in accounting method. The second one is improves reliability of financial statement. There are many stakeholders of a company and they rely on the financial statement for their information. Many of the stakeholders base their decisions on the data provided by this financial statement. Then there are also potential investors who make their investment decisions based on such financial statements. So it is essential that these statements present a true and fair picture of financial situation of the company. The accounting standards ensure this. They make sure the statements are reliable and trustworthy. The third is prevents frauds and accounting manipulation. Accounting standards lay down the accounting principles and methodologies that all entities must follow. One outcome of this is that the management of an entity cannot manipulate with financial data. Following these standards is not optional, it is compulsory. So these standards make it difficult for the management to misrepresent any financial information. It even makes it harder for them to commit any frauds. The fourth one is assist auditors. Now the accounting standards lay down all the accounting policies, rules, regulations in a written format. These policies have to be followed. So if an auditor checks that the policies have been correctly followed, he can be assured that the financial statements are true and fair. The fifth one is comparability. This is another major objective of financial accounting standard. Since all entities of the country follow the same set of standards, their financial accounts become comparable to some extent. The users of the financial statement can analyze and compare the financial performances of various companies before taking any decisions. Also, two statements of the same company from different years can be compared. This will show the growth curve of the company to the users. And last, number 6, determining managerial accountability. The accounting standards help measure the performance of the management of an entity. It can help measure the management's ability to increase profitability, maintain the solvency of the firm, and other such important financial duties of the management. Management also must widely choose their accounting policies. Constant changes in the accounting policies lead to confusion for the user of financial statements. Also, the principles of consistency and comparability are lost. Now, let's discuss about limitations of accounting standards. There are few limitations of accounting standards as well. The regulatory bodies keep updating the standards to restrict this limitation. The first one is difficulty between choosing alternatives. There are alternatives for certain accounting treatments or valuations. Like for example, stocks can be valued by last in first out LIFO, first in first out FIFO, weighted average, etc. So choosing between these alternatives is a tough decision for the management. The accounting standard does not provide guidelines for the appropriate choice. And second limitation is restricted scope. Accounting standards cannot override the laws or the statutes. They have to be framed within the confines of the laws prevailing at the time that can limit their scope to provide the best policies for the situation. Now let's discuss the process of formulation of accounting standards in India. The formation of Accounting Standard Board is the first one. The Institute of Chartered Accountants of India, or ICAI, recognizing the need to harmonize the diverse accounting policies and practices at present in use in India, constituted an Accounting Standard Board, or ASB, on 21st April 1977. The main function of Accounting Standard Board is to formulate accounting standards so that such standard may be established by the Council of the Institute of Chartered Accountants of India. While formulating the accounting standard, the Accounting Standard Board will take into consideration the applicable laws, customs, usages, and business environment. The institute is one of the members of the International Accounting Standard Committee (IASC) and has agreed to support the objectives of IASC. While formulating the Accounting Standard Board will give due consideration to international accounting standards issued by International Accounting Standard Committee and try to integrate them to the extent possible in the light of the conditions and practices prevailing in India. The accounting standards will be issued under the authority of the Council. The Accounting Standard Board has also been entrusted with the responsibility of propagating the accounting standard and of persuading the concerned parties to adopt them in the preparation and presentation of financial statements. Accounting Standard Board will issue guidance notes on the accounting standards and give clarifications on issues arising therefrom. Accounting Standard Board will also review the accounting standard at periodical intervals. Efforts will be made to issue accounting standards which are in conformity with the provisions of applicable laws, custom, usages, and business environment of country. However, if due to subsequent amendments in the law, a particular accounting standard is found to be not in conformity with such law, the provisions of the said law will prevail and financial statements should be prepared in conformity with such law. The accounting standard by their very nature cannot and do not override the local regulations which govern the preparation and presentation of financial statements in country. However, the institute will determine the extent of disclosure to be made in financial statement and the related auditor's report. Such disclosure may be by way of appropriate notes explaining the treatment of particular items. Such explanatory notes will be only in the nature of clarification and therefore need not to be treated as adverse comments on the related financial statement. The accounting standards are intended to apply only to items which are material. Any limitations with regard to the applicability of a specific standard will be made clear by the institute from time to time. The date from which a particular standard will come into effect as well as the class of enterprises to which it will apply will also be specified by the institute. However, no standard will have retroactive application unless otherwise stated. The institute will use its best endeavors to pursue the government, appropriate authorities, industrial and business community to adopt these standards in order to achieve uniformity in presentation of financial statements. In carrying out the task of formulation of accounting standards, the intention is to concentrate on basic matters. The endeavor would be to confine accounting standards to essentials and not to make them so complex that they cannot be applied effectively and on a nationwide basis. In the years to come, it is to be expected that accounting standards will undergo revision and a great degree of sophistication may then be appropriate. Broadly, the following process will be adopted for formulating accounting standard. The Accounting Standard Board shall determine the broad areas in which accounting standards need to be formulated and the priority in regard to the selection. In the preparation of Accounting Standard Board will be assisted by study groups constituted to consider specific subjects. In the formation of study groups, provision will be made for wide participation by the members of the institute and others. Accounting Standard Board will also hold a dialogue with the representatives of the government, public sector undertakings, industry, and other organizations for ascertaining their views. On the basis of the work of study group and dialogue with the organization, an exposure draft of the proposed standard will be prepared and issued for comments by members of the institute and the public at large. The draft of the proposed standard will include a statement of concept and fundamental accounting principles relating to a standard, definitions of the terms used in the standard, the manner in which the accounting principles have been applied for, the presentation and disclosure requirements in complying with the standard, class of enterprises to which the standard will apply, date from which the standard will be effective. After taking into consideration the comments received, the draft of the proposed standard will be finalized by the Accounting Standard Board and submitted to the Council of the Institute. The Council of the Institute will consider the final draft of the proposed standard and, if found necessary, modify the same in consultation with Accounting Standard Board. The accounting standard on the relevant subject will then issued under the authority of the Council. While discharging their attest function, it will be the duty of the members of the Institute to ensure that the accounting standards are implemented in the presentation of financial statement covered by their audit reports. In the event of any deviation from the standards, it will also be their duty to make adequate disclosure in their reports so that the users of such statement may be aware of such deviation. In the initial years, the standards will be recommendatory in character, and the Institute will give wide publicity among the users and educate members about the utility of accounting standards and the need for compliance with the above disclosure requirements. Once an awareness about this requirement is ensured, steps will be taken in course of time to enforce compliance with the accounting standards. The adoption of accounting standards in India and disclosure of the extent to which they have not been observed will over the years have an important effect with consequential improvement in the quality of presentation of financial statement. Now let's talk about need for convergence of accounting standard with International Financial Reporting Standard IFRS, or we can say with global standards. Indian accounting standards are set of accounting standards notified by Ministry of Corporate Affairs, converged with International Financial Reporting Standard IFRS. These accounting standards are formulated by Accounting Standard Board of Institute of Chartered Accountants of India. Convergence means alignment of the standards of different standard setters with a certain rate of compromise by adopting the requirements of the standards either fully or partially. Indian accounting standards are almost similar to IFRS, but with few carve-outs so as to make them suitable for Indian environment. Now let's discuss the benefits of convergence with IFRS. The only thing which will be received from such transition is common set of accounting standards. The benefits of having the common standards for financial reporting are the reasons which attract this transition. Now let's discuss one by one. The first one is better comparability. By following a common set of standards will help the stakeholders to compare the organization globally. Let's take example to create an apple-to-apple comparison. Apple India with Apple USA. Next is better transparency. The users of accounts will be benefited by this, as same accounting standards will help them to understand the fundamentals of the organizations, which will generate better transparency. Next is many companies having subsidiary or holding company in different countries are required to follow dual set of accounting standards. Local standard on one hand and global standard on the other hand. The transition will be helpful in saving time and cost on the finance department. Next is attract foreign investment. Since the investors can compare with other organizations globally, it will help them to take investment decisions. At the same time, it will help the organization to present their financial position in more efficient way to the world in a language that all can understand. Next, due to transition, many companies will be attracted towards India for investing, for setting up subsidiary, etc., which will result in increase in employment opportunity. Next point is globalization. Globalization can be understood at three levels. World trade, smooth trade can be achieved. Listing security markets, listing of securities on international stock exchanges will be eased. Cross-border flow of investment will lead to economic growth. And third is stakeholders. Stakeholder can easily take the decision in regards to the organization. It also helps for cost saving, saving of time and money in planning and executing of accounting and auditing. Costs involved in the access to the capital market are expected to reduce. It also decreases the labor cost. In developing countries, the labor cost is cheap, but capital availability is difficult. By convergence, the cost of capital will reduce and its availability will also be eased. Now, let's talk about applicability of accounting standards in India. From this discussion, one may wonder why to introduce Indian Accounting Standard or Ind AS instead of following IFRS as it is. Some countries had accepted the IFRS as it is instead of convergence. Question is, why not India? One of the main reasons is any changes in IFRS would have impact on books of Indian companies. It would be hard for companies to adopt or cope up with IFRS as and when amended. At the same time, India is multi-regulator nation. In India, we are having different regulators like we are having Companies Act, Income Tax Act, we are having Securities and Exchange Board of India, SEBI, Insurance Regulatory and Development Authority, IRDA, Reserve Bank of India, etc. To welcome the change in IFRS, the respective rules and regulations must be amended accordingly, which can be time consuming. If the changes in IFRS are not in consensus with the rules and regulations, then there will be chaos in corporate reporting. So, introduction of Ind AS or Indian Accounting Standard is a way to buy some time to analyze the situation or the change with the view to take necessary action by Ministry of Corporate Affairs as it thinks fit. Hence, substantial similar to the IFRS, the Indian Accounting Standard have some carve-outs to ensure that these standards are suitable for application in the Indian environment. Some of the challenges are rules and regulations, since there are many rules and regulations in India for implementation of Ind AS. The appropriate amendment must be done in the rules and regulation. Technological aspect. Right now, bookkeeping and accounting is done through software like Tally, Miracle, Busy, SEP, etc. These accounting software are based on Indian GAAP and accounting standard. There will be a huge cost to invest in such upgrade software. And last is employees, personnel. There is lack of efficient personnel. However, it can be avoided by training and awareness program. With this, student, I am ending. Thank you very much.